The rallying cry of the last several months has been austerity in the developed world. If you think about the implications of austerity and look at what we saw in GDP figures from the UK in the fourth quarter, would you say that maybe we are ignoring the risks of austerity in our enthusiasm to get budgets under control?
Well, I'd put it in some context. It's a transition to austerity. It's not the age of austerity hasn't arrived across the G20. It's a transition to austerity. The G20 agreed in Toronto in June at the summit for a sensible, in our opinion, a very sensible transition path. Cut deficits in half by 2013 and stabilize debt ratios by 2016. That's what we're going to do in Canada. That's what everyone else has signed up to do, and that is an appropriate path given both the scale of the stimulus that's in place and the necessary aspect of unwinding it.
Now, the UK is starting in a deeper hole, but plans to balance its budget by around the same time that Canada does. Are you maybe thinking now that that's perhaps too ambitious a goal?
Well, I must say that I spend most of my time thinking about the Canadian situation as opposed
the
to
Canadian
the
budget.
Oh, the Canadian situation. Well, those are the G20 arrangement is the right one. It's the right framework. Canada has a lot of fiscal flexibility. We have options, and they will be put in place, and the government will decide exactly how to achieve those. It is important to get back to a sustainable fiscal path, without question, in Canada, even though we start with the strongest fiscal position in the G7.
How about the way that world bond markets are handling it? Clearly Canada is not being punished, but other countries are. Is there clearly this is an issue that policymakers have to confront all the time, the degree to which they feel that they're charting the right course, a responsible course. Take Spain, for example, and the degree to which the markets don't give them credit for it. Is there, and that clearly is a problem in Europe right now, is there a way out of that conundrum?
Well, the experience, and our experience in the 1990s in Canada, is it takes a while to rebuild credibility. You have to underpromise and overdeliver. You have to have clear objectives to start with. You have to have clear milestones, and you have to beat those milestones. You have to take measures that are sustainable. One-offs aren't going to work. You have to be transparent as possible. This is hard work, without question, and it takes a while to build that credibility. And once you find yourself offside of the bond market, you do have to do more things in order to get back on side, and that's just the reality.
Clearly, the prospects for the Canadian economy are largely dependent on what happens in the United States. How confident are you in the pace of recovery in the U.S. right now?
Well, two things. One, we've been growing domestic demand twice the rate of the United States. So the prospects for the Canadian economy, the outcomes in the Canadian economy have been largely a product of what's been going on in Canada. And certainly on the margin and going forward, it's incredibly important what happens in the United States. What we're seeing, what we've been seeing in the last several months, has been a pickup in U.S. activity, an important pickup in U.S. activity outside of government. I mean, obviously the fiscal package that was announced in December is important. It's going to add almost a percentage point to growth in 2011. But we also are seeing a resurgence of consumer activity in the U.S. This is not the U.S. of the first half of the last decade, but there are some welcome early signs, and that is going to help.
At the same time, though, is it possible those welcome early signs are being met by too much optimism that this recovery is sustainable?
Well, we have to be careful, and certainly on the policymaking side, we absolutely have to be careful. There are broad forces of deleveraging that existed when we were here a year ago. We've made a marginal amount of progress over the course of the last year in household deleveraging in the United States and the UK. The sovereign side has continued actually to leverage, as you referenced at the start. So there are big moves that still have to happen. They're going to play out over the course of the next 5 to 10 years. And to think that we're returning in the advanced economies to a very robust pace of growth would be misplaced.
Do you share the view George Soros shared with me yesterday, rather, that ultimately an interest rate or a monetary tightening by the Fed, which at some point is inevitable, who knows when, will really begin to shut down the U.S. economic recovery?
Well, I think the Fed is certainly alert to the timing of any adjustment to monetary policy, and they're very focused on achieving their dual mandate. And I think it actually goes the opposite way. The Fed is not going to make a move that would call into question its ability to achieve its inflation or employment objectives.
You brought up the dual mandate. Do you think the Fed should have a dual mandate or a single mandate, an inflation-fighting mandate only?
Well, I would say that we're very happy with the simplicity of our inflation targeting mandate. We were the second country, as you know, to adopt inflation targets during the crisis and coming out of the crisis, and at moments like this, when focus comes back on inflation. It's incredibly helpful to have the discipline of a simple target. Whether there was risks of deflation, we were here last year, people were worried about deflation. We were doing things in order to get to 2%. Now people are worried about food prices and the pass-through impact on inflation, but we can calibrate things in order to achieve that target. It makes a big difference.
It's said that in fighting inflation, you can't help but keep considerations of growth in mind, and ultimately, you can't not intend to create jobs at the same time. They're all. Is that fair to say?
It is. Well, in our view, it's absolutely fair to say the best contribution that, in our view, monetary policy can make to employment creation is low, stable, predictable inflation. In order to achieve that, we need to calibrate demand growth consistent with the growth of the supply side of the economy. And so, yes, in calibrating monetary policy, let's take monetary policy in Canada right now. Interest rates are 1% with a very well-functioning financial system. They're in 1% because of very strong headwinds that are coming from the global economy, also from the currency. And that is going to ensure, in our view, that demand growth is consistent with growth of supply in order to achieve that 2% inflation target. It's the discipline of the target that drives that, but it's not, all these other factors are the product, very important byproducts of this focus on inflation, growth and jobs.
How serious a risk right now are those rising commodity prices, those rising food prices to the Canadian economy and to the global recovery?
Let's take from the global recovery first. I think one of the big upside risks, if you will, is that growth momentum in emerging markets goes on for longer and becomes unsustainable. It's unsustainable in some major emerging markets at the moment.
There already?
There is a need for additional tightening of policy. I'm not going to be drawn on which ones, but it would appear that that is the case. And there's a short-term benefit of that for economies like Canada. Higher commodity prices, better terms of trade, better incomes, investment, etc. But if it's an unsustainable pace, ultimately there's going to be an adjustment farther out, and it's extremely important that policy is calibrated appropriately. That means policy that's right for individual countries, not policy that's imported from the United States.
Okay, but that does raise a question. If we have imported inflation in developed economies, does it not complicate, possibly seriously, the exit strategy for monetary stimulus?
Well, it's no. If you have a credible inflation targeting regime, it does not complicate it. And I'll take Canada as an example. Food prices, relatively small part of the basket. Very little evidence of pass-through of food prices to the underlying inflation, because in part most food is processed. There's lots of other costs that come there, in part because the currency moves as well. And also importantly, if food prices go up on a one-time level, even if it's a sharp shock, you can look through those as they're doing in the UK. The issue is if there's persistent upside surprises on food prices or other commodities, then one may have to adjust.
The G20, Canada ran it last year. It would seem with some success. Many were hoping that Nicolas Sarkozy would outline a strategy and outline objectives for the G20 yesterday when he was here at the World Economic Forum. We didn't get that. Do we not need it?
Well, I think what President Sarkozy has done has been very useful. He has set quite lofty goals, quite high goals, and there's an opportunity for finance ministers, for governors, and more broadly, to telescope those goals and focus in on real deliverables in order to improve the functioning of the international monetary system. The President is entirely right in raising this issue, putting it at the center stage. We shouldn't avoid that. Is there a magic bullet? Do people have the answer for how to solve it? No. Should we make material progress on having a better functioning system by November? Yes. And so I think the President has done a good service to the G20.
Can the G20 end the currency war?
Well, it depends whether I'm not necessarily going to accept we're in the middle of a battle at the moment. I think we're having constructive discussions around adjustment of policy. It's partly adjustment of policy. It's partly acceptance of responsibilities that already exist.
What's the risk of speculative inflows to Canada, as if the Canadian economy continues to improve, the currency remains strong?
Well, we're not an emerging market. I mean, we have a very deep financial system, we have the most integrated financial system with the United States, we welcome foreign investment. We'll see our fair share of foreign investment, and we'll adjust monetary policy appropriately to achieve that 2% inflation target if we are seeing certain pressures.
Is there a substantial risk in your mind that the Canadian dollar will strengthen further from its current level?
Well, one of the risks to the Canadian economy is persistent strength of the Canadian dollar. We have a competitiveness problem in Canada. We have had a current account swing of 6 percentage points over of GDP over the course of the last 3 years. That's been driven in part by currency, in part by problems in the United States, but also by poor productivity. So we need to get a hold of this competitiveness problem. So yes, it is a risk.
Would a weaker dollar at this point, let me put it to you this way, to what degree would a weaker dollar, Canadian dollar, help to underpin the Canadian recovery?
Well, cheap money isn't a growth strategy, or cheap currency isn't a longer-term growth strategy or business strategy. Ultimately, what we've got to focus on in Canada is improving productivity, investing in people, investing in infrastructure, and that's going to make the difference. From a central bank perspective, we'll take the level of the currency, the volatility of the currency into account in formulating monetary policy, but again, with that purpose of achieving our inflation target.
What more could Canadian policymakers do to encourage the investment that you say is necessary?
Well, I think first we got to draw attention to the scale of the issue, and that's what we're doing. Secondly, from a central bank perspective, it's pretty simple: achieve our inflation target, make sure the financial system continues to function well so they can access capital. There's a broad range of things on the infrastructure side that need to be done. We've got tax competitiveness in Canada, and that's important. We're going to start to see the benefits of that. We've got to open new markets. The government's negotiating big free trade deals, potentially with the European Union, a number of major emerging markets. That will make a difference. But again, it's the flip side. We don't have the austerity issue necessarily that we started this discussion with, but we've got a long slog on productivity. That's the issue that we've got to work.
Has Canada diversified itself away from its dependence on U.S. trade enough? Does more need to be done on that front?
More needs to be done. It's more than 10 percentage points move in terms of our dependence in the U.S. trade. But we are underexposed to major emerging markets. We get the commodity price benefit, but we're not as plugged into the supply chain dynamic that we should be with China in particular, and so we need to expand on that pretty rapidly. The good news is there's a lot of upside. There is a lot of upside for the Canadian economy.
So, U.S. share of Canadian exports today is about 70%, correct?
Yes.
Okay. To get where you think it ought to be, what would that number have to?
Well, I'm not going to set a Obama-esque goal for doubling exports to certain markets, but suffice to say, it would be substantially less.
Here at the World Economic Forum, there seems to be a battle of sorts emerging between, and it's a familiar one, between the banks on the one side and the forces of regulation on the other. The banks saying...
The forces of good, we were about to say? Or
no, you didn't say that. You might say that. Is that a healthy tension right now, given how much work needs to be done to get the global economy back on its feet?
I think what's important is that the regulatory side, the policymaking side, understands the perspectives of the institutions, understands the perspectives of all the stakeholders, so corporate borrowers, retail customers, is thinking about the impact of all these measures on the system, both in terms of stability and efficiency. I think we've made a lot of progress in the last, or certainly over the course of the last year. There's a few more things to need to be done. There's more uncertainty still around regulation than there should be, and we need to deliver some more clarity in 2011.
Are the bankers right that less regulation at this point would contribute to the global economic growth?
I don't think, if the argument is that the challenges we have in global economic growth are the product of properly regulating the financial sector, that's entirely wrong. With the financial sector is being put on sounder footing, that matters. That is a bigger contribution. The countries that have strong financial sectors, the countries that have recapitalized their financial sectors, I'll take the United States as an example. The Geithner stress test and recapitalization, incredibly effective and an important contributor, I think, to what we're seeing now in the U.S. recovery. There's more that needs to be done without question, but it's where there's been foot dragging, either by the institutions or on the policy side. That's the impediment. So it's not a question of let's put regulation to one side and things will be fine. That would not be the case.
You spend a lot of time with these bankers. Do you have confidence in them right now?
I certainly have more confidence than we did a few years ago. No, there's been progress. There's a lot more that needs to be done. I wouldn't put this quite as adversarially as you have. There's always going to be tension. But there's different objectives. There is a broader objective.
But on a personal level, are they going to get it right? The banks themselves. We'll ignore the regulators for a moment. That's your job.
Yeah. I think the answer to that is some banks will not get it right, and so we need to design a system that allows those banks, or ensures that those banks who don't get it right, bear the consequences of making mistakes, but the system doesn't bear the consequences of those mistakes. And we're moving in that direction, but that's got to be the end point.
All right, Governor, thanks so much.
My pleasure.